The countdown has begun, and Jake Claver just made one of the most outrageous statements that anyone in the XRP community has ever heard even more certain. He still thinks XRP could reach $750 by the end of the year, and he's now adding to what he calls the derivatives phase. In this phase, XRP could one day be used in global derivative settlements worth hundreds of trillions of dollars, which could raise its long-term value into the thousands. This is not advice about money. Let's start. Jake Claver is not giving up. This week, he was asked if his belief in XRP's triple-digit goal has waned now that the year is almost over. His answer was quick, 100%. I feel even more sure of myself every day. He said that his guesses are not just random guesses or wishful thought. They have to do with certain macroeconomic triggers or real structural events that he thinks will cause a supply shock in XRP's available liquidity that has never been seen before. What does that mean? It's when there isn't enough supply to go around and demand goes through the roof. This has happened before in other assets right before soaring price moves, but the size is very different with XRP. There are currently about 59 billion XRP tokens in circulation, but a large number are still locked up in Ripple's lockup. Jake talks about levels like $750, $1,000, or even higher for XRP. For these levels to happen, the supply on markets would have to drop by a lot. Jake says that the number of XRP tokens that are available could drop to as few as 100 million once ETFs, institutional liquidity products, and settlement methods start to use it. That's when things get crazy with math. Take a look. If XRP is worth $750, its market value is about $45 trillion. If it's worth $1,000, it's closer to $60 trillion. When most people see those numbers, they think that's impossible. However, Jake says that this is no longer about a speculative crypto market. It's about how a new financial structure is taking shape below the surface. He connects it to a number of factors coming together, such as the popularity of tokenized assets, the instability of the bond market, the move away from Tether as a liquidity source, and the launch of XRP-based ETFs that could allow a new wave of institutional involvement. He said that once the institutional layer starts to work, the demand shock will not only temporarily raise prices, but it will also reset the base value of XRP for good. It all comes down to how value moves, which is the most important thing. He thinks that XRP will be the plumbing for the new banking system. If XRP is used for global payments, trade finance, and derivatives, its price will no longer be affected by individual speculation. Instead, it will be affected by the need for global liquidity. Let's look at the side of futures. This is where his 5-digit XRP prediction comes from. The notional value of the world derivatives market is between $400 trillion and $1 quadrillion. This includes options, futures, swaps, and structured products. Those numbers sound crazy, but they're actually the contracts behind them, not the cash value. The real amount that has been settled or backed up is probably only $10 to $15 trillion. Still very big. XRP would change the price patterns a lot if it were used as collateral and settlement asset for even a small part of that market. Let's say that XRP only helps with 1% of derivative payments. That's the movement of about $10 trillion in cash. When you divide that number by the number of XRP coins that are actually in circulation, you get hundreds of dollars each. When you raise that to 5%, you're well above 500. If XRP ever made up 10% of all global derivative payments, Jake's $1,000 prediction would come true. And how did he figure out the difference between $10,000 and $50,000? This is when you think about limited quantity institutional custody and the fact that XRP is used as a layer of collateralized liquidity in many different financial networks. Not just derivatives, but also bonds, stocks, and payments across borders at the same time. That's the worst possible situation, one that would need full unity around the world. Jake thinks that this merging starts with Codius, which is Ripple's platform for smart contracts. It's been in the works for years, and David Schwartz, Ripple's CTO, says that if he ever left the company, he'd spend all of his time building around Codius. That's important because Codius would let complex derivatives and structured financial goods be stored directly on the XRP ledger. These would all be protected by XRP, which is used as the settlement token. To get from simple payment rails to global derivative design, you have to do it this way. Let's go back to 2008 to see why this is important. One of the biggest problems with the system that was shown by the financial crash was that derivatives were not clear. There was no central record to keep track of risk, and no one knew who owned what. With the ability to use smart contracts and show spread liquidity, XRP could be the tool that fixes that. Every derivative contract could be issued, watched, and settled in real time on the blockchain, so there would be no need to guess about exposures. That's what Jake's theory is based on. XRP will be used to settle all global financial risks, but it's not all that. He's also making connections between these events and current big events, such as the end of the reverse carry trade, uncertainty in the bond market, and changes in liquidity in Asia. All of these things together make up what he calls the perfect storm. If these things happen at the same time, ETFs, swaps, bond collapses, tether redemptions, and institutional inflows, it's not just an XRP rally, the asset's value changes completely. He says that when big organizations like SWIFT, central banks, and ETFs start using XRP, its price won't just go through the roof, it will stay high because of the value locked in the network. That is, once trillions of dollars worth of payments are made every day through XRP, that will be the rule. Jake's reasoning here is based on the simple model of supply and demand that a 5-year-old could understand. If there is a set amount of XRP and the number of trades and institutional uses goes through the roof, the price will have to go up to keep up with the demand. That's just good economics. Jake breaks it down even more. About $5 trillion is settled every day through SWIFT. Even if XRP only got a small part of that flow, the liquidity needed to support those trades would drive its price into the triple digits and keep it there. The stock market settles between $5 and $6 trillion every day, so now there are two huge financial streams running through the same network. More people who need to buy things with XRP makes its price go up and stay high. The rules change totally once it is recognized as a Tier 1 asset and held in the banking system. After that, XRP goes from being a digital currency used for speculation to a settlement tool used all over the world. This is the moment of change that Jake Claver is talking about. We're right outside the door. The first one to fall is the ETFs. Once those are cleared and institutional money starts to flow into regulated XRP products, the supply will start to tighten. Stores won't even know it's coming. While people are arguing about whether XRP can go above $5, institutional desks may already be getting ready for the liquidity squeeze that will make the asset worth $25, $50, or even $100 plus. Don't forget that it's not about the hype, it's about how it works. XRP's value on public platforms drops to almost nothing once enough money is locked up in ETFs, institutional custody, and collateralized derivatives. Price can change a lot in a very short amount of time because of math. Huge desire meets a small supply. That's where Jake is coming from when he says he's 99% sure we'll see triple digits by the end of the year. Building is important, not just hope. He thinks that all the pieces are falling into place. The end goal is reached when macro liquidity, institutional acceptance, clear regulations, and ready infrastructure all come together. XRP is going to be the main part of the next age of financial systems. That's where we'll start again. Because Jake also talks about the specific things that he thinks will cause that supply shock and how long it will take for the market to fully reprioritize after the ETF is approved. The chain effect he talks about is really cool. It's already beginning to happen. Jake Claver says that the perfect storm for XRP is already happening, and it's caused by flaws in the old tax system. His idea is that the new rails, especially XRP and the XRPL, will quietly take over the role of global payment once those cracks get bigger. He separates the triggers into layers, and like dominoes, each layer sets off the next. The first is monetary tightening, which means that central banks are having a hard time dealing with rising debt costs and low liquidity. That's when money starts to leave risky assets and move into tools with high liquidity. I think that's where Jake thinks XRP comes in. He calls it the liquidity pivot, and it's where money starts to look for settlement speed instead of speculation. The second thing he says is a cause is the unstable bond market. Jake says over and over in his talks that the bond market is the most important sign in the world economy. Governments can't pay their debts when bond rates get too high without printing more money. And when they print more money, prices go up even more, trapping central banks. He says that this cycle forces institutions toward tokenized payment models that lower risk, cost, and friction. Systems like SWIFT and Fedwire are used by banks and governments to settle huge amounts of money right now. They are slow, cost a lot, and make it hard to get cash. Ripple's technology, on the other hand, settles and completes deals right away. Once the bond market gets even tighter and debt-based liquidity runs out, the world will need faster collateral rotation, which is exactly what XRP was made to do. The third thing that makes the market move is the arrival of ETFs and institutional liquidity. Jake says that this is where the market shock starts. As soon as a spot XRP ETF is approved, big buyers can legally buy it, and regular investors can get exposure without having to hold the funds themselves. The ETF takes XRP out of circulation like a vacuum. Think about what will happen when ETFs, exchanges, custodians, and companies all want the same limited amount of XRP. The amount of usable float drops quickly. Because XRP has a limited supply, even small amounts from ETFs could cause the price to rise. Jake calls this ignition point, or the time when the market realizes how rare XRP really is. He also talks about something he calls the Tether unwind. Those funds need to go somewhere if people ever lose faith in stablecoins like Tether. In the past, they would move into Bitcoin or cash. But in Jake's plan, XRP would be the best regulated liquidity option because of pressure from regulators and approvals for ETFs. A quick switch from unregulated stablecoins to digital assets that are suitable for institutions could bring in huge amounts of capital, which would make the supply even tighter. Jake also talks about the reverse carry trade, which is one of the more technical triggers. It's the situation where banks and funds that borrowed foreign currencies for cheap now have to pay a lot to return them as interest rates rise. When those contracts close, liquidity needs to move quickly, which often makes FX markets unstable. He thinks that the price could go through the roof if that unwinding happens at the same time as tokenization and cross-border payment projects that already use XRP. But derivative integration is what really supports his theory and is what he talks about the most. Let's look into that more because this is where the idea of a settlement layer worth trillions of dollars starts to make sense. The world derivatives market is very big, but it's not well organized. To keep track of risk, banks still use complicated separate systems. XRP and the XRPL could be used as a clear, customizable layer to make contracts, back them up, and settle them. Let's look at a simple case. A derivative deal worth $1 billion is made between two institutions. With the way things are now, payment can take days or even weeks because there are many middlemen and risks. The same contract could be turned into a token on the XRPL, have its terms automatically carried out by Codia smart contracts, and settle instantly in XRP. Now multiply that by tens of millions of contracts across global banks, and XRP is needed as collateral for daily transactions worth trillions of dollars. That's where the idea of $10,000 to $50,000 in XRP comes from. That value doesn't just appear out of nowhere. That's because the amount of global value that needs XRP to move could possibly drive its price to that range if supply stays low. But Jake is sure of one thing: these numbers don't relate to the near future. They are long-term and have to do with the futures phase. Triple digits by the end of this year is the short-term goal, which is driven by ETFs and institutional demand. The multi-thousand-dollar values come after the infrastructure has been stable for years, and CODIAS and institutional tokenization are widely used. It sounds like a cash ladder to him. To begin, cash comes in through ETFs. Then banks start using XRP as a way to send money to other countries. Next, CODIAS adds smart contract features, which make structured swaps possible on XRPL. As soon as that layer is locked in, settlements will start to go through it. This will increase traffic and keep prices high. There is no one switch that needs to be flipped. This is also linked by Jake to what David Schwartz said about CODIAS. Schwartz has made several hints that CODIAS is not dead. It's just sleeping until the environment is ready. He said he'd build a business around CODIAS if he left, which tells us a lot. In other words, Ripple is still working on making settlements more scalable. XRP is no longer just a bridge asset once smart contracts are up and running. It turns into a secured source of cash for customizable finance. Every transaction, every derivative, and every tokenized bond could use XRP to clear instantly. That's what organizations care about. It's not small-scale speculation, it's smooth liquidity with clear accounts. This ties in with another part of Jake's thinking that was missed. The info from the BIS, Bank for International Settlements. As of April 2025, they said that trade in over-the-counter interest rate derivatives reached about $7.9 trillion per day. Even if only a small part of that moves to tokenized settlement rails like XRPL, it will create demand that is much higher than the present value of XRP. Now, some people have the wrong idea about what notional and derivatives means. There is no real money changing hands. It's the value that all the contracts are based on. The smaller but still huge amount of real cash that changes hands every day is the liquidity that is needed for settlement. That's what XRP would stand for. Settlement liquidity, not value in theory. Jake thinks that if XRP can take even a small part of that, say 1% to 5%, the price will easily reach the hundreds or low thousands. It's math. But he also talks about another factor, stable prices due to steady demand. When institutions use XRP every day for payments, they can't have it go up and down. That's why ETFs are so important. They produce more liquidity and lower volatility by putting XRP into long-term institutional custody. When supply goes down, the price goes up sharply. Once steady institutional demand takes over, the price stays the same. He feels the most sure of himself at this point because it's no longer just a theory. Pilots for tokenization are already running. Unified ledgers for real-world assets are being talked about by big organizations like BlackRock, Citi, and the World Bank. Ripple is a part of the system because it works with central banks and payment providers. Every month, tests are done on new passageways. Integrations of CBDC are happening right now. Ripple doesn't sell retail claims. It's building pipes for schools and hospitals, and that plumbing needs water. Jake's framework says that cash will be XRP. Once that switch is made, when value needs XRP to move, price will reflect how useful something is, not how much it's worth. Jake imagines that when ETFs come out, prices go through the roof, and all of a sudden, big banks realize that XRP has become the new standard. Once that standard is stable, it will be used for settlement. That use keeps the price even more stable, causing a cycle of adoption and growth in liquidity. More institutions have to join as the loop grows, since no bank wants to settle on slower lines. In the same way that SWIFT took over many years ago, the network effect. The network is now faster, cheaper, and designed to work all over the world. This is what he calls the digital monetary reset. Not because of a plot, but because it was bound to happen. Our old method is too slow to deal with markets that happen in real time. Digital currencies, tokenized bonds, and derivatives all need a single backbone for trading. That's where XRP shines brighter than anything else on the market right now. Jake is sure of himself because of how well the timing worked out. There are cracks in the banking system, rules are getting stronger, and technologies are coming together. Activation of cash is the last piece. The repricing phase will start after that, and he thinks we're right on the edge of that. He is not the only one who thinks this way. Several macro analysts have said that the best time to change digital infrastructure is between 2025 and 2026. Launches of CBDC, ISO 2022 messaging, and tokenization tests are all happening at the same time. XRP is right in the middle of all three of these things. That's why Jake keeps saying it's not just a crypto play, but a realignment of wealth around the world. If he's right, the first signs of that change could show up in the coming months. There were early use cases for swaps, ETFs, and moving money around. All of these signs show that the market is about to understand what XRP is really for. As we go on, Jake explains what happens next, including the massive influx of money from institutions, sudden changes in supply, and the feedback loop that could permanently change the price standard for XRP. So Jake Claver isn't exaggerated when he says that the world is about to change. He's talking about the working stage of something that has been going on since at least 2015. Digitizing money, making it easier to send and receive value, and combining power into programmable cash are all examples of this. Because look at what's going on at the same time. Through the BIS Innovation Hub, the IMF is trying how well CBDCs can work together. RippleNet is already built into more than 70% of the tests run by central banks around the world. All of this is based on the ISO 2022 system, which is now fully live across SWIFT. That is not evidence of a plot, it is proof. There are quiet changes being made to the world settlement network. The US is also intentionally behind. Why? As the dollar is the most important currency in the world. You don't change the setup you made. The competition is a part of it. This is exactly where the cryptocurrency market comes in. In reality, regulators have been slowing down the business to make people move into areas that follow the rules. That's why Ripple has kept growing abroad while also keeping in touch with its US banking partners in a quiet way. They aren't against the system. They are updating it from the inside out. Claver means a financial world in which all major assets like money, gold, real estate, bonds, energy credits, and even tokenized stocks can easily move between digital networks that can talk to each other. Settlement takes place across countries in real time with no delays or problems. As of now, the real power doesn't come from owning things, but from controlling the systems that make them work. The digital roads, bridges, and standards that make it possible for value to move. Whoever controls that infrastructure has control over global cash and, by extension, global economic power. So now it makes sense to talk about how XRP is built. There is no store pump token in it. It's an important part of the financial system that was made for banks, companies, and the cross-border back end of the money system. Take a look. For XRP to do well, the dollar doesn't have to die. It only needs to change. The Federal Reserve and the Treasury are already making digital dollar rails with the help of the private sector. Along with that, Ripple's technology offers the neutral bridge asset that lets all other CBDCs work together. Tokenization is the process of representing real-world assets on blockchain. When you put these two things together, you get the biggest capital unlock in history. In just seconds, assets worth $1 quadrillion that aren't easily traded or moved become tradable, can be used as protection, and can be moved across networks. That's the real point Claver is making. Adding crypto to the institutions that support global banking is like adding rails to a train. All of standard financial infrastructure and blockchain-based liquidity come together. The best part is now here. This isn't going to happen in decades. The design has already been put in place. In 2023, ISO 2022 went live around the world. The CBDC tool from Ripple is currently being used by a number of central banks, the Mariana, Helvetia, and Enbridge projects. It's not a white paper. They are prototypes that are being tested in the real world. At the same time, political stories, gold-backed systems, brick deals, and getting rid of the Fed all hide what's really going on. The change from an economy based on debt to one based on cash flows. The next age of value will be controlled by whoever is in charge of those pipes. And the U.S. isn't going away. It's getting better. In secret, with a plan and with assets that most investors still consider risky. That's the reason why smart money isn't making noise, because this change is already over by the time it becomes popular. It's becoming clear that XRP plays a big part in that economy. It's what holds the old system together and the new one together, whether it's cross-border payment, interoperability between central banks, or managing the liquidity of digital assets. It's not fear when Jake Claver says, "We are in the middle of a controlled demolition of the financial system." What it does, the destruction is done digitally. The rebuilding can be programmed. The machinery is also up and running. No longer is it a question of if this will happen. They are the ones who get it before everyone else.